want to learn how to manage your own investments? Are you ready to stop paying investment management fees and start building wealth? The DIY Investing Podcast is dedicated to providing you with the knowledge, skills, and resources you need to be a better investor. Learn how to make investments through the use of fundamental analysis, mental models, and business management insights. Now, here's your host, value investing expert, Trey Henninger.
So welcome to the DIY Investing Podcast. This week I have a special guest on the show, Science of Hitting. He is an investor that has written for GuruFocus for 8 years, and I've followed his writing for some time. And I believe that his insights on value investing should be very beneficial for you, our audience. Science of Hitting self-describes himself as a value investor with a long-term focus, and he also runs a concentrated investment portfolio. So let's welcome Science of Hitting to the DIY Investing Podcast. Welcome.
Thanks for having me.
So what I'd like to do is start by asking, how did you first become interested in investing?
Yeah, I kind of stumbled into this when I went to college. I went to the University of Florida, and I had no idea what I wanted to do, basically. So my dad was a plumber, and for that reason, I thought, well, I guess I'll try building construction as a place to start. After a year or two, I realized that wasn't the route for me. And fortuitously around that time, Buddy and I stumbled across Warren Buffett's shareholder letters. So we both got hooked. And shortly after I changed my major to finance, that next year, I think it was 2009, we actually decided to drive from Gainesville to Omaha for the shareholder meeting, which was, I think it was 25 hours each way, which is a pretty good haul. And my mom got us a hotel room one of the nights, but I think the other nights we slept in Walmart parking lots. So it was quite a commitment for us at the time. So, but yeah, I've been hooked ever since. And after I got out of school, I went to work for an investment advisor in Jacksonville, Florida. And then I went back to school and got my MBA and moved to an RIA in Georgia. So for basically the last 10 years, I've just been plugging along and working at trying to be a better investor.
That's awesome. So basically you had no introduction to it before reading the Buffett letters?
Yeah, correct. Basically nothing.
So this is more like a eureka moment. It's like, this makes sense.
Yeah, pretty much.
Okay, yeah. See, I think that's one of the things I've liked the most about Buffett is he has a saying that value investing either clicks immediately or it never does. And I think that
Yeah, it all made sense to me from the start. It's a very logical approach.
So how have you seen any difference between, what you learned from like reading Buffett's letters and what you learned in school as being a finance major to kind of what you see when you're working in your RIA?
Yeah, I mean, in terms of things that he used to talk about a lot, I guess he doesn't talk about it as much anymore, but in terms of efficient market hypothesis and things along those lines, some of the things I learned in school were not as helpful to what I do today. But I think, having those shareholder letters and now the resources they have online with the old annual meetings, it's been such a good resource that it kind of was my education in a lot of ways, at least in terms of investing. In terms of how I've kind of evolved over time, I'd say when I first started, I was a lot closer to what you would think of as a traditional value investor. But as time's gone by, I think my appreciation for high quality businesses and sustainable moats and good managers has kind of become more important than just pure valuation. And I think that's something that, as we kind of were discussing before, that a lot of investors learn over time. So yeah, I think that's been a big part of my evolution, especially in the last 5 years or so.
Okay. So, with that, it's like you say you're kind of moved away a little bit from traditional value investors. So do you see a difference between, calling yourself a value investor versus say like a quality investor? Or do you see that as all part of the same system or different parts? Or how do you view that in terms of like your investment process?
I think I view it all as the same bucket. I think it kind of, it's the way you approach the exercise of finding investment opportunities, which I would describe as, a lot of people might run screens and just find the cheapest stocks and then try to back their way into good businesses. And I think for me, I've found that approach is not very effective for the type of investor I am, which, as you described, is a long-term investor, and concentrated investor. So for me, I found it much more useful to kind of flip that equation and go, what are the good businesses? And then from there, try to find ones that appear reasonably priced. I've ran into enough difficult situations, I'll say, when I flipped that equation and looked at the valuation first. I just don't think with the long-term time horizon that's the correct way to approach the question. Okay.
So you say a long-term time horizon, and I think one of the things I've seen in my own studies of the market, and there's we're all students of the market, I think, when you're an investor, is that everyone has a different definition of long-term. Some people, long-term means they held the stock for a week when normally they're a day trader, and some people long-term is 50 years. So kind of how would you define long-term in terms of like the time horizon that you look at?
So my two largest positions currently are Berkshire and Microsoft, and I've owned them both since 2011. So that kind of gives you a sense. And in terms of Berkshire, I've never sold a share. And in terms of Microsoft, I've trimmed at times, but not very significantly. So I'm very comfortable holding for those periods of time, especially if I'm comfortable with the quality of the business, the quality of the management. When I find that combination, I've learned that being really pinpoint accurate in terms of what you think on valuation can be a mistake. When you're with good people and good businesses, you get those positive surprises that you might not build into a model. And I think it's important to recognize that you shouldn't let that combination go easily.
Okay, so you've held them, close to 8 or 9 years, and so
yep.
I guess the idea is you're comfortable with that sort of time horizon. Do you see those types of positions as something you'd be willing to hold the rest of your life? Or do you look at those on an annual basis or a quarterly basis? How often do you check yourself when you consider what would make you sell such a long-term position, I guess? Doesn't have to be specific, but what sort of process do you have in terms of that sort of thing?
Yeah. So I stay on top of the quarterly results, obviously, and, all the major filings. In terms of, what I think you're getting at basically is there kind of a valuation or a price level that would lead me to sell. And obviously there has to be some limit to that. So the number's not infinity.
Yeah.
But again, I think I've learned that you probably should have a longer leash on those type of names than you would on, a lower quality business where you're looking for a catalyst or you're basically looking for a re-rating at the end of the day, is what I think a lot of people are doing, whether they say that or not. In these businesses, Berkshire, if it goes to 180 or 220 compared to current stock price of 200 or whatever it's at, that just isn't very material to me, because I'm thinking about it in terms of what it's going to do over the next 5, 10, 20 years. And as long as I think those prospects are reasonable, it being 10% cheaper or 10% more expensive really isn't very material. So there's a limit to that, obviously, but as long as they're at levels where I think you can make a reasonable case that they're still attractive investments, then I'm willing to hold them.
Okay. So
and there are tax implications as well, which is a reality of being an investor. So
yeah, I mean, you hold things longer term, assuming it's in a taxable account, then the longer you hold it, the better that turns out to be for you.
Correct.
So just to kind of go down a little deeper on that piece, when you're talking, so you're definitely sounding more like away from, let's say, if we're going to call traditional value investing, the original idea is you buy a stock at 35% or 50% discount, and then you sell once it hits fair value. So that's certainly where you say you're moving more towards quality. It sounds like, where you're not necessarily selling as soon as the stock hits fair value if it's something you consider that has a quality management and a quality business. Is that right?
Yeah, that's fair. I think there's I think how I might reword it is there's a lot of false precision in the idea of, a pinpoint intrinsic value estimate. And I also think there's a lot of value in having history with companies and management teams where you can get more comfortable with, a bad quarter or a bad year. You can, if you have people that you're, partnered with that you trust and you think are making intelligent long-term decisions, I think it's a lot easier to weather those kind of events. So I think there's some intangibles associated with that approach that are probably underappreciated in some ways.
Okay, that makes sense. The other piece that you had said in that previous comment that I wanted to touch on was, I think sometimes there's a segment of the value investing community that believes, if you're not willing to buy a stock today, then you should sell it. That basically that there's not a range where a stock can be both not a buy and not a sell. So they kind of exclude this idea of there's like this holding period. How would you say you fit along that spectrum?
Yeah, I think, in a lot of these conversations in investing, you have these black and white positions, and almost everything is some shade of gray. So I can understand what people mean when they say that. I just think when you're in practice, you kind of have to be more practical. A stock obviously that you think is worth 150 is now at 200. That's a real conversation you have to have. But when you're talking about, again, 5 or 10% swings in either direction, I think people can get a little bit too focused on what's happening with stock prices. And it probably doesn't help that all of us live in a world today where we're checking stock prices all the time. So that definitely has a behavioral impact. But I can understand what people mean when they say that. I don't want to be as fanatic in that view as I think some are.
No, I mean, I certainly agree with you. I just think it's always interesting when you talk to a different investor for the first time and you're just kind of wanting to see how they land on that, because I think that's something I've struggled with in the past is, well, to me, it makes sense that there's a hold range. Like you said, there's imprecision and you need to adjust for that. So there's two things I haven't heard you mention on, and I think I know your answer, but I want to kind of understand, how do you feel about momentum and technical indicators like charting?
Yeah, they're not factors that really play into my process at all. Whether they have implications on short-term price movements, they very well may. It's just not something that's ever really been my focus. I'm perfectly comfortable buying a stock, and if it goes down 10 or 20%, I just accept that as part of the game. And if I think it's a good opportunity to add more, then I will. But for the most part, I just disregard that stuff as kind of a noise or a distraction that impedes my ability to just focus on what I think is most important, which is long-term value creation and buying reasonable businesses at fair prices.
That makes sense. I mean, it's certainly what I've seen for me is I think there might be something to it, but it just like we said earlier in our conversation, I think value investing, if you find it and it clicks with you, it's going to click pretty quickly. And neither of those have clicked with me myself, but I've seen.
Yeah, I think the issue to some extent, you find a reasonable business at a fair price, and let's say the momentum indicators or technical indicators, whatever you want to look at, if they suggest it's going to fall, is that a fair reason to not buy the stock? For me, I'd view that as a mistake, because I've found what I'm looking for. So why am I adding another layer? Yeah.
No, I think that's certainly, you mentioned reading the shareholder letters. I know when I went through them myself, I think that's one of the things that Buffett repeatedly rails against is you find a business that's good, they have good management, it's valued well, and you're going to make a lot of money in the next 5 years. But you're worried about losing money in the next 3 months, and doesn't end as well.
Yeah, you see this also. I see people talk about this kind of with option strategies as a way to, get in a position that they like, but they wish it was 5% cheaper. So they start doing, different option strategies. And I think at the end of the day, when you zoom out, the correct answer is probably maybe buy a little bit less than you want to, or just be patient and wait for it to get your price. But I think people add these extra layers and maybe they create some value in the short term. I'm just kind of doubtful over the course of an investment lifetime that they're really making a difference. And importantly, they might make you miss on something that you wish you would have bought. So
that makes sense.
That's how I kind of think about it.
Yeah, that makes sense. So when I've read a lot of your writings, you tend to write primarily about large cap companies. I didn't know if there was a reason for that, because you're mainly looking at large cap companies, or if those companies are the higher quality companies, or do you have a preference for large cap companies, or is it just maybe a wider audience? I was just kind of wondering if you could comment some on that.
Yeah, there's no huge preference. I'd look at anything that I think is reasonable. Some of the things that I look at that are smaller, I get a little bit tentative about writing about, especially if they're really small. And it's also kind of the nature of my role at the firm that I work for. We tend to focus on larger ideas only because we have a level of assets that, a company that's worth $100 million would be difficult for us to invest for our clients in. So that's kind of where I'm naturally pushed to. But yeah, mid cap, large cap, I'm comfortable with companies of any size as long as I'm comfortable with the business and the management.
Gotcha. That makes sense. So you talk about being a concentrated investor. So again, I think this means different things for different people. So I was just curious if you could comment on, like, how many positions do you like to hold at once? Do you like to hold cash? And maybe what are the reasons behind that?
Yeah, so I looked in preparation for this. Currently, I have 17 positions, but it's very top heavy. So the 5 largest are 2/3 of my portfolio, and the top 3 are 40% of my portfolio. And it's based on the businesses and what they, kind of what their operations consist of. I feel like from the perspective of a business owner, it's sufficiently diversified. Over time, the short-term fluctuations take care of themselves, and I don't have any issue with underperforming on a daily, weekly, monthly, yearly basis. It's not how I'm kind of grading myself. If I'm correct on the investments I made over the long term, things will work out just fine. In terms of cash, I've gone back and forth on this over the last 5 years or so, and I guess being in a long-running bull market probably has impacted my thinking in some ways. I've come to the conclusion that having some cash I have no problem with, but I do think in some ways the idea that you're going to have 20, 30, 40% cash, I think you can get yourself in trouble playing that game. And I think it starts to get relatively close to market timing, and you're kind of, the advantage that you have from being invested over long periods of time, you're in some ways nullifying that. So I can understand why people like holding cash, and I've done it before in the past. I've just grown less interested in that approach. I think if you find good businesses that are trading at reasonable prices, it's not the best idea to be sitting and waiting for, that once in a lifetime opportunity.
Yeah, I mean, I think I know myself when I have held, let's say greater than 20% cash, but there was a time in the last 5 years where I held probably 80% cash. And I think it was at those times where I make the worst decisions. I don't know if you've seen similar.
Why do you think that is?
I think because, and it's probably part of the emotional side where, you have a lot of cash and there's a fear of missing out that I think every investor has, even up through Warren Buffett, that you have to handle. And of course, the better investors have a better way of managing it. But I think when you are when you're researching a company and you have a lot of cash, I think it's impossible for you not to know that. Mm-hmm. And then when you know that you have a lot of cash and you see a company and you're saying, man, I'm really targeting, let's say 10% returns, but this thing will give me an 8% return and cash is 2% or 1%. Right. And it's really hard to sit there and say, like you said, if you're out of the market for, it's like, how long do I sit on it? Do I wait a year, 2 years, 3 years until I find that 10% stock? Or do I just say, hey, 8% is a pretty good return, especially if you're confident in it?
Right. I think it also helps. And basically what you're saying in a different way is it helps to frame the opportunity cost when you're comparing relative to a business that you own, that you have some idea of what you think reasonable forward return expectations are. When you're comparing to a hurdle that's cash, for me, it kind of muddies the whole thinking on it. And it also is the idea that, say, obviously there were plenty of people who were worried about stuff in 2011, 2012. I think 13 was the year the market was up 30%.
Yeah.
If you go into that period with 30% cash or 40% cash, for me, it's a difficult mental exercise to then go, now's the time to allocate. Because let's just say across the board, everything was 30% more expensive. Obviously, that's not accurate, but just as an idea, it just makes it difficult. You're constantly playing this game where, for me, it's just not the most comfortable way to do things. And I can understand why others would disagree, but for me, it's not an approach that I grew uncomfortable with the idea of having these large cash holdings when I found businesses that I thought were worthwhile to hold. So.
No, that makes sense. I mean, I know the way I fixed it for myself was to no longer raise cash based upon, let's say, the market ever. And like, if I raise cash because all of my companies are becoming much higher valued than I'm willing to hold, and then that is just being forced. Like, but but I'm not going to raise cash because I think the market's high, or I think, a few the companies are high. It's going to be like, if I have companies to invest in, I'm going to invest my cash. And if I don't, then that's the problem itself. But the key point, like you said, is, your discount rate or your opportunity cost. If you ever are comparing just to cash, then everything's going to look good.
Yeah. And we also live in this weird world now where, the discount rate is, I tend to think about it as you kind of framed it, which is kind of an absolute hurdle, say 10% or 12%, whatever the number is.
Yeah.
But I think the reality of the world today is, our hurdle in terms of fixed income is 2% or 3%. So I think there has to be some consideration, and I'm not perfectly settled on how I think about this, but I don't think just an absolute hurdle is probably the most realistic way to invest these days. I think you have to have some perspective for what you're getting on a relative basis. And yeah, I just think it's something worth thinking about.
Yeah, I've certainly thought a lot about it. I know my current stance, and my listeners will know, is that my current stance is basically an absolute hurdle and a relative hurdle. And so the absolute hurdle is a minimum. And my relative hurdle would be if comparing to my other opportunities. So like my absolute hurdle minimum is 10%, and which is, I understand, high, because you talk to most fund managers and they'll tell you that's a high discount rate today. But then my relative hurdle only comes into play if the opportunity cost is maybe 12, 15% or whatever. Like, let's say interest rates were at 20%, using a 10% discount rate doesn't make any sense anymore.
Right.
But I'd rather hold a little bit more cash, but I've not had that problem in a while. So, as long as I'm able to be fully invested with a discount rate of 10%, I think I'm doing all right. But
I also think it's worth thinking about how you get to having cash in some ways. Let's say you're fully invested. Are you getting to having cash from selling investments where the thesis is just broken? Or are you selling investments where the business is performing, but you just think it's too expensive? And I think for a lot of people, the selling in the second case is where you can get into some trouble. Now, granted, I'm saying this in the context of a 10-year bull market, however long it's been. So obviously I'm influenced by what's happened. But I look at someone like Chuck Ockery, who owns a lot of high quality businesses and doesn't tend to hold a lot of cash. And he seems to have the ability to let things run more than probably a lot of other investors would, especially people who are really tied into their models and their fair value estimates. And I think there's a lot to be said for the way that he approaches it. You have to accept the fact that things might sell off 30%, but he's in businesses that he likes. And I think the ability to stick with those and kind of live with the volatility in a lot of ways works out better than the alternative.
No, I agree. You mentioned 2012 and 2013, I think it was probably a trap for some people. And I wasn't doing a huge amount of investing at that time. But if you were to sell, because the whole market's up 30%, and you're like, man, this is just, unsustainable. Well, since 2013, we've averaged 15% returns in the market. So,
right.
You're going to look back and consider yourself kind of stupid because, so much of your things barely hit fair value.
Right.
So, yeah.
And it wasn't obvious then. People might look back and, pretend like it was, but it was just like how it feels today.
Yeah, no, if the market, if the market went up 30% today, basically, because we were, you had 2015, 2016, you've had these down runs, and then, if the market spiked 30%, it's going to feel tough to not sell. And
right.
We could talk all we want about, I certainly think there's some sort of bubble in the market, but I'd rather not spend too much time talking about the market itself. But
yeah.
So one thing I was curious about is, you mentioned when you were talking earlier about, you're very comfortable with the management of Berkshire and Microsoft. So I was wondering how you evaluate the management of a company. Like, what are you looking for? That sort of thing.
Yeah, I think the approach I've become comfortable with is kind of inverting the question. And, Warren Buffett made the comment many times over the years of, there's seldom just one cockroach in the kitchen. And, you turn on the lights and all these other ones start scurrying around. And I think that's the approach I've grown most comfortable with. I'm willing to give management teams the benefit of the doubt, and I try to be realistic and don't hold people to unreasonable standards. But when I see red flags, I don't forget them easily. So what does that mean in practice? I'm looking at stuff like proxy statements. How much stock does management own? What are they paid? What are they paid based on? Stuff like that. Another resource for me that's been super helpful is I like going back and reading the old shareholder letters if the company has them, or old investor day transcripts. Those are always helpful. You can get a sense for what the company was talking about 5 or 10 years ago. Were they setting targets? Did they hit those targets? When they inevitably missed some targets, did they address them head on, or did they try to sweep them under the rug? And I think you can get a good sense from looking at things like that. One example that has stuck with me from a few years ago was a CEO at a company that I won't name. He, in his shareholder letter, he spent more time talking about basically $1 million in donations that employees made after an earthquake in Haiti than he did on the $1.6 billion in securities losses from write-downs in their portfolio. So obviously on scale, the one is almost 2,000 times larger than the other one, and he basically didn't talk about it at all. And for me, that's just inexcusable. It's immediately move on to the next one. And you may get some false positives from doing that, but that's kind of a risk I'm willing to take. And I think this goes the opposite way as well. You can find good managers as well from reading shareholder letters or looking at investor days. When you see people who really rub their nose in it when they make a mistake, I don't think you want to let those people go lightly. And again, from my perspective, in terms of investing, it's a lot easier to deal with volatility and short-term issues in the business when you're partnered with people like Warren Buffett and Charlie Munger, or someone like Walt Bettinger at Schwab, or Brian Roberts at Comcast, Satya Nadella at Microsoft. These people are the kind of people I want to be partnered with long term. And again, when I find them, I don't want to let them go easily, because I don't think, just looking at the numbers, you might have a compelling case to leave sometimes, but I think if you have the perspective of years or decades as opposed to the next 6 months, a lot of times I think it's just a mistake.
Yeah, that makes a lot of sense. I mean, I think I like what you said about red flags. I think that's one thing that I pick up on a lot is I'm looking for signs that maybe the management just doesn't get it in terms of what investors are looking at or are interested in. Sometimes there's a mismatch between thinking, investors are all short term, or they want to just hear a good story or something. And there certainly are those people. But I want to find those partners I can be with for a long period of time. So have you ever made an investment in a company? You don't have to mention the company if so, but where you didn't like the management, but you invested anyway? And how did that turn out?
I'm sure in most cases it was after being invested for a period of time that, as I, like most things, being invested kind of makes your ability to follow the story and learn what's going on more acute. So I think there's cases where I've recognized as time went by that I was less comfortable with the management team than I thought I was. I think a good current example, something that I own but not much of, is probably Facebook. Their capital allocation just doesn't make a ton of sense to me. And again, when you think about it, in some ways it kind of makes sense. Mark Zuckerberg has a lot of things to worry about outside of capital allocation. Whether or not they're doing repurchases is probably not top of mind for him right now, understandably. But they're holding a ton of cash. They're generating a ton of cash. I don't see any way realistically that they're going to use that cash. And it's kind of just sitting there burning a hole in shareholders' pockets at the end of the day. So, I notice things like that. And obviously it's not a deal breaker for me because I still own the stock, but it is something I recognize, and it gives me a shorter leash as I think about my model and what kind of fair value is. So that's probably how it influences the way I do things in practice.
Okay. So do you think, how would you rate the importance of a manager's or CEO's capital allocation in terms of, in the threshold of things that you're evaluating management on? How important is capital allocation of the different things you might look at?
Over long periods of time, it's incredibly important. But I don't want to be the kind of person who's going, oh, the stock was down 10%. Why weren't you buying back more than you were 6 months ago? So again, I'm trying to make sure I'm very reasonable. I just want to have a sense for whether or not there's, any sort of plan or strategy in terms of how a company's going to allocate capital. And to the extent there isn't one, I've kind of become more accepting of the view that large special dividends are a reasonable way to, return cash to shareholders when it has no use internally. or no use, at least not fully. Like Facebook is spending a ton of money, obviously, on CapEx, but they don't need all the cash they're generating, and it's not clear to me how they ever could. So in that scenario, I think it's pretty important, but it's not the only thing I focus on. Again, all this stuff is part of, what's the term, a mosaic. It's one piece of the pie. So I try to keep it in perspective, but it's definitely an important one.
Yeah. No, that's true. I think a lot of times with these big tech companies, which are in the news all the time, and that have turned the corner on operating leverage and are start throwing off a lot of cash. Where, like you said, with Facebook, they're a lot of cash production. So it doesn't matter that they're putting in a lot of CapEx; they're still increasing their cash holds. It's really hard, whether with share repurchases or dividends, if you don't do something like a large special dividend to actually get rid of that cash in any sort of reasonable time frame. So,
right. And on the other end of the equation, you have companies where, the CEO might not be the founder, just came into the job. And if the business is struggling, a lot of times they don't have a ton of options for what, say the business is still generating cash. Yeah. They don't have a ton of options for what they can really do. I mean, they can repurchase shares, which if the business is in trouble might not be the right decision. They can try to turn, like a Bed Bath & Beyond we were discussing before, or, a lot of these other retailers, if they're still generating cash, it's not clear what they should do. Maybe they should invest in e-commerce, or maybe they shouldn't. But I think it's very difficult to just say, we're going to return this all to shareholders or do something completely unrelated to our core business, even though in a lot of cases that might be the right answer. So I try to avoid those situations where management is going to be put in a really tough spot in terms of capital allocation. That's the beauty of something like a Berkshire or Markel, where they have a lot of flexibility to do what looks most reasonable at the point in time.
Yeah, and a proven history too, right? I mean,
correct.
The history, although I think every investment ever has the past results don't mean future results or something along those lines, and all sorts of legal language. The history, I think you can learn something from it. If not, then basically there's nothing for value investors to do if you can't look at history. But
right.
Do you prefer founders as CEOs to what I'll say is like an MBA CEO, or have you not seen a preference in that when you look at your investments? Or
yeah, it's not. I can understand why people focus on that, and I think it's important. I think what it implies is what I really care about. So it's the ability to make long-term decisions without a ton of focus on short-term results. So you see someone like Buffett and Munger, obviously. You see what Jeff Bezos has done. There's also other cases like Glenn Renwick at Progressive, their former CEO. I mean, he was a very capable manager, and he wasn't the founder of the company. But I think, it's investing in businesses where they're not playing that game of just constantly trying to impress the street and beat by a penny. And those are kind of few and far between. But when you find them, you should recognize it and not let them go lightly.
Yeah. I mean, so one of the methods that I've kind of worked on in my own process is kind of rating the management and then the way that the company's business is done, like to determine how much trust I give it, basically. So, some companies I'd sell if they reached fair value, and then some because I don't think they're a good business or something like that, or it was just more of a, buying because it was a steep discount. And then other companies, because I don't limit myself to just quality or just non-quality or, just deep value. I kind of hit the range. But what I do is kind of look at it and say, okay, you have this company that has a great manager and a great business, let's say something like a Berkshire, has very high quality businesses like C's as part of it. And so I'm going to give it more range on the upside before I would sell than I would another one that it barely hit my fair value or it's 10% below my fair value and I'm going to sell now because I bought it at 70% below,
Right.
So,
yeah, I think that's reasonable.
So I was wondering, you've learned a lot from, I think, writing about investing, and I've enjoyed reading a lot of your writing. And in some of that, you've talked about some of the differences between, I guess, the requirements and the needs of an individual investor versus like a fund manager. And I was just curious what you would consider like the best advantage that an individual investor has over a fund manager.
Yeah, I think the answer for me is that, individuals are able to basically step back from the noise and truly think long term. I think a lot of people in the business don't really have that luxury, whether they want to admit it or otherwise. And I kind of see this in the world that I live in. We try to push back on it, but it can be difficult. And I also think that people in the investment business tend to view action, buying or selling of any kind, basically, as tangible evidence that they're actually working hard. and I don't think that's what actually matters. So, I just think for individuals, the idea that you can just sit back, not do anything, and make a handful of meaningful decisions every year or every couple of years is a really powerful tool. And I think naturally that pushes you towards being more selective and really focusing on high quality businesses, and waiting till the time is right that you can make an investment that you're highly convicted in. And I think that's very likely to work over the long run.
So do you think that's driven by the fact of kind of the things it forces you to do? Like you said, it pushes you towards high quality businesses. And I think that's true. Like if you have that ability to think long term, you're more likely to be pushed into those businesses because you're going to make less decisions. Do you think it's maybe more on the making less decisions part, or do you think it like maybe the fact that it's pushing you to high quality businesses is really driving some of that capability? Does that make sense?
Yeah, it does. I think it's definitely a mix of both. And I think, inevitably when you're judged on, yearly, quarterly, whatever short time frame people will focus on when you're a fund manager, I think you have to basically end up playing a game where you're really just trying to guess what's going to get re-rated the right way. Yeah. That's really what it is, because that's what's going to show up in the numbers over that type of time frame. But when you're zooming out, again, anybody can go and pull up the charts for different businesses, and you'll see companies that have done extremely well over the last 20 years, and you'll find other businesses where the stock hasn't gone anywhere in 20 years. And I think as you think about what that means and what the underlying businesses are behind those stock prices, it helps you appreciate that certainly there's some level where you can pay too much for a good business, but over long periods of time, that compounding and the importance of that to returns is evident.
Okay.
So
yeah, no, I think certainly don't want to underestimate that.
And just the idea, as we all know, hey, you're going to buy something, you can't touch it for 10 years. Where would you start looking first? Is your most important thing going to be PE ratios, or is your most important thing going to be finding a business with a long runway that can actually have higher earnings with a high degree of confidence? Naturally, you're going to focus on the second variable in that decision.
Yeah, I think that's some of the biggest benefit that Buffett has given to the investment community is some of these bite-sized snippets where if you just think of things in a certain way, your investment results are going to improve significantly. Like you don't have to even be that much better of an investor. You're going to make better decisions because you're thinking in a certain way.
100%.
So I think, you talk about how, your experience working at an RIA and, finance background. What do you think individual investors maybe don't understand enough when they're getting into investing? So like, where are the pitfalls that they might be missing compared to, say, an investment manager that might understand something better than they do?
Yeah, I think something you might learn over time, as I've learned, I'm sure you have as well. Just the inherent uncertainty, I guess, of businesses and investing, especially as it relates to short-term results. The idea that some company is going to consistently quarter after quarter just beat expectations is kind of a fallacy. Even thinking about it, the only company I can think of that probably has done that is GE, and in some ways they're still paying for that 2 decades later. So, you should. The focus really should be on going to investments with the right mindset in terms of the time frame and what realistic outcomes are. And you should really recognize the game you're playing and the risks associated with doing so. Everything has trade-offs. So I just think people need to be realistic about their expectations, and also the idea that something being 20% down from when you bought it 2 months ago is part of the game.
Yeah, no, it definitely is. So this is my favorite question that I like to hear from people. It might not be your favorite question, so you can let me know that. But what is your worst investment mistake that you've made, or at least that you're willing to share, and what did you learn from it? Oh man,
yeah, I've had a fair number of them. I think the worst one was probably JCPenney, which I invested in a few years ago. The outcome was bad, but I think even, just the process and how I got involved was probably what really was the mistake. First off, I kind of let myself get sucked in by somebody else's work. And, I still did the work on my own, but I think it's safe to say in hindsight that when I was doing the work, I kind of wanted to believe the story, and I did. It's also an example where, I kind of let the cart get ahead of the horse in terms of what I was talking about before. I focused on valuation a lot more than I did on the quality of the business. And I think you could have made a pretty easy case at that point that it definitely wasn't a great business. And that's a lot more apparent today. And that's a mistake I've made a few times, especially in retail. And finally, I think I'd say that when it started to not work out, I was very slow to recognize that the thesis was flawed. I think looking back, they went through a period of time where the same store sales, the comps just imploded. And at that point, I think it was clear in hindsight that this was basically a bet the company kind of transformation. And if it didn't work, you were looking at something that was going to be worth significantly less than what it was trading at. And that's kind of the route that's played out. But yeah, at the end of the day, I think I lost like 60% on that investment. And I went back and read my postmortem about JCPenney that I wrote a few years ago the other day. And people can go read it if they want. It was painful to reread.
Yeah. But do you think that's helpful to write it down? I've found it helpful, but it's hard to do that, right? Yeah,
it is. It is. And I think, you need the ability to step back and let a little time go by. If a stock's down 30% after 6 months or a year, I don't view that as a mistake or a proof that you were wrong. And same goes for it being up 50%. I think with 5+ years having gone by, it was clearly a mistake. It was a big mistake. And I think sitting down and thinking about why the mistake happened and putting it in writing is very helpful.
Yeah. I think something you just said was probably one of the things I'm really going to take away from this interview. And it was that the mistake, it sounded like, and so correct me if I'm wrong, that really the mistake was driven by the fact that you made a decision based on just valuation, and that, probably what really hurt you was that it was a bad business. Do you think that's a common theme from when you've made mistakes? It's what I've seen on myself, is that when I make the worst mistakes. That
is by far the most prevalent theme whenever I've made mistakes. I think, it's the idea that Charlie Munger talks about. If you're invested in a business that has, 20% returns on capital or 25% returns on capital, if that holds for a long enough period of time, that'll account for basically any starting valuation. Obviously, there's limits on that, like anything, but you understand what I'm saying. On the other hand, if the business has terrible returns on capital, that eventually is going to be reflected in the stock price as well. So for me, that's been a major focus in the last handful of years, which is flipping the equation and not letting valuation drive the research process. It's finding great businesses, and then from there, you might go, hey, this thing's 50% too expensive or whatever. That's fine. Just, put it in the back of your mind or track it in some way and move on to the next great business. But I think it's a real mistake to go, here's the stuff trading at 12 times. Let's find what's the best out of these things. I think that's backwards.
Yeah. So with that, so do you have a watch list, or like from your past stuff you've looked at, or how do you do that?
Yeah, I have a watch list where I try to make sure to stay up on the quarterly results for the companies that I think are high quality. And some of them are way beyond levels that I'd be willing to invest in. Heiko is a good example right now. But I'm just trying to keep track of the story, and as it gets closer, I dive in more. But yeah, I try to keep a relatively short watch list of stuff that I would love to own, but just not at the right price.
That makes sense. So
yeah,
what I want to do now is kind of shift gears a little bit and kind of talk and kind of dive a little bit more into a specific example, because I think examples are helpful for learning. And is there a specific company that you would say kind of epitomizes or is a good example of your research process, how it's helped you, or kind of what you look at, and we can kind of talk in more depth about it?
Sure. Yeah, I mentioned it earlier. I think Microsoft's an interesting one because, for one, I've owned it for a long period of time. And secondly, I think why I got into the investment originally and what it means to me now has also kind of evolved. And I think it's kind of tracked my evolution as an investor. So I originally bought it back in 2011, and I think it was kind of a more traditional value investment. The underlying business is very high quality, but I think there were concerns about, sustainability of the moat. Was there any ability to grow, et cetera? So at the time I invested, I think it traded like 10 times earnings. And they had a bunch of cash. So people were basically, pretty pessimistic on their future prospects. I looked back, I wrote an article at the time called Microsoft Price for Failure. And I think that's probably pretty fair. I think most people who are bullish or bearish would probably agree on that. But yeah, so my argument from the start, or the way I was thinking about it, was that even if people were right that the death of the PC was a kind of a common refrain back then, and which for Microsoft would mean the death of Windows, I thought even if that did play out over a number of years, that the math still kind of made sense. So at that high level, you could probably argue that there wasn't a ton of depth to my thesis, which that's probably fair. Over time, though, I followed the business and the company more closely. And when Satya Balmer, when he announced that he was stepping down in 2013, I think I had a pretty good sense for the business and the story. And when they named Nadella as a successor, I remember at that time, like in the press, the reaction to it was kind of odd to me. I think almost everything I was reading was negative. The idea that they were hiring an insider was basically viewed as a mistake and that they were doomed for failure now. The thing I found interesting about it was everything I read from people who actually knew Satya Nadella suggested otherwise. They suggested he was very open-minded, that he'd be a good leader. And I think over the ensuing years, the perception has certainly changed. I think he's kind of proven that he was a very good pick. So over that period of time, I just think what started as kind of a traditional value investment morphed into something different. And it gave me an appreciation for being in these high-quality businesses that have large addressable markets. Company has a fantastic balance sheet. I think they have best-in-class leadership, and the stocks run a long way over that period of time. And as anybody who has owned it over that period knows, it's hard to just keep holding it. You want to trim it, you want to get out completely, whatever. I think being patient with this name and holding it for a long period of time has been an important lesson for me in terms of how I think about investing. Obviously, it doesn't mean the stock won't go down 10%, 20%, 50% over the next year. But I think it's realizing that if I look out 10 years, I can build a model today that I think has reasonable assumptions that says the stock is worth something close to the current price. Maybe it's 10 or 20% less. But I think I can get reasonable returns. And most importantly, I'm partnered with people I really like to be partnered with. And I think it's a very good business. So I don't want to let that go too easily. So
that's really interesting. So, I have... It's always interesting to hear what first attracts you about a company that you've held for a while, and to with the benefit of hindsight, hindsight's 2020. And I haven't. I'm aware of Microsoft and I know a lot about it because if you work at all, it's impossible to not know about their products and if you've used a computer, right?
Yeah.
So it's like it's a company that you might be aware of, but it's interesting to hear, the death of the PC or death of Windows, because, if you look at the results, well, I think it's been the opposite, right? So yeah, you look back and say, oh man, buying Microsoft at 10 times earnings, it's a no-brainer, right?
Yeah, and just important probably to add, obviously there's been a huge change of perception. So a lot of the run in the stock price has been, valuation driven. And I also think it's important to note that there's undoubtedly been a large amount of luck as part of this investment working out. So I think it's just important to recognize that. And, you have things that move against you and that you're unlucky on. So it goes both ways, but I think it's worth calling out.
Yeah. What I want to mention for the audience here who doesn't necessarily know about it, is just listening on their phone or in the car. Microsoft's currently trading at like $133 per share. In 2011, it was mid 20s, $25. I think is I think that's right with any splits.
Yeah, that's right.
And so you're talking 7x, maybe 6x the stock price, and I do believe they pay dividends. So they've been paying dividends that time. So it's the sort of thing where 6x in 8 years, that's a really strong return. I don't know if you've looked at the percentage returns you've received from that investment, but I would assume it's over 15%, 20%.
Yeah. I think I haven't looked at numbers recently, but last I saw, I want to say not over that whole period of time, but I think the last 5-year CAGR is, I'm pretty sure it's north of 25, but don't quote me on that.
Yeah. But that's the sort of thing where it's the perfect quality investment that you would want. in terms of you buy it as a value investment and you get to hold it as a quality investment, right? But
yeah,
what I'm curious though is how did you not sell? When have you? Because it couldn't have been easy seeing because at some point here the stock price started to go up in price. So you say you bought it at 10 times earnings. A quick screen says it's at 26 times earnings. So when did you realize it was a quality investment and that it was worth holding as the PE ratio increased?
Yeah, I think this gets to kind of the overarching theme of what we're talking about here too. And I think it's, this idea that I've become a lot less ironclad on the view that you need to own the most of what you think is cheapest on a, traditional, hey, this thing trades at 70 cents on the dollar, and you need to get out of the stuff that trades at $1 or $1.10. I think it's just too it's too precise and it's too valuation or number focused. And obviously I'm not saying to disregard those things entirely, but it's this idea that, you could see over time as Satya Nadella became CEO, especially, and not to say Ballmer did everything wrong, but it was definitely a change in terms of what you were hearing about the culture internally and what the company was focused on and, where they were moving strategically. So you had a lot of positive tailwinds. And I just think the idea that when you see that happening, that you're going to go, okay, this thing trades at 18 times. It used to trade at 16 times. I need to get out now. I think that's probably the wrong way to approach investments. And, you can just think about the way Warren Buffett invests. He bought something like Coke in the 80s at presumably what he thought was a good price. He lived through the run up in the 90s. And I think a lot of people give him some heat for that, or the idea that he should have sold out. And, it hasn't been a great investment from there, but I'd also argue that some of the story has changed a little bit and it's kind of moved against him, and it hasn't been a terrible investment. So I don't know. I just think this idea that you can partner with great businesses and great managers, you shouldn't just be looking to get out when something appears to least bit expensive. And again, people should go look at Chuck Ockery, look at his fund and look at his track record. And he's held most of those stocks in size for, as far as I know, 5+ years, and it's worked very well. So.
Yeah, that makes sense. I think it's just a very good example of how you need to be willing to adjust and be flexible with your investments, because you don't know what's going to happen. No matter what we look at in our spreadsheets, no matter what we look at in terms of analyzing the filings, you can't, I doubt you predicted in advance that the CEO was going to retire or step down in 2 years after you bought it, right?
Correct. I did not.
That was not part of your thesis, but it doesn't mean your thesis had broken or that you didn't have to adjust your thesis, right?
Right.
So you talked about.
I think this is just to make another point too. I think it's, this is again where having like the long-term perspective is kind of a different way than I think a lot of people look at it. And it's hard to straddle both worlds. I think a lot of people would go, I think you said it's at 133. If it trades down to 100 a year from now, that's a pretty significant drawdown in the short term. But I just don't view that as it's not a risk that's really material to me or something I care about. If it gets cheap enough again relative to what I think it's worth, I can just buy more, or the company will repurchase shares, or, it's not like I don't play this game where you're just looking at it from, today to a year from now. I'm thinking about it in a continuum over the next 10, 20, 30, 40 years, which is how long I plan to be investing for. And when you think about it that way, I think you'll find that the returns will move closer to the underlying returns on the business, as opposed to these temporary changes in the PE, basically.
Yeah, I think that's a great point, which kind of brings me to kind of what the last question I want to ask you to, how do you judge your own performance? How do you evaluate yourself? Not how people evaluate you, but how do you evaluate yourself in either a specific company or across your portfolio?
Yeah, I tend to view it at the portfolio level, and I've been doing this, as I said, for roughly 10 years, and obviously over that time, hopefully I'm a lot smarter than I was 10 years ago or 5 years ago.
Yeah.
But I've just reached the point now where I had enough money and I was sufficiently diversified for the results to be kind of material as opposed to just owning one or two stocks, where I now have kind of 5+ year track records. And I just tend to think about that in terms of, relative to an absolute hurdle, as we discussed earlier, and also relative to what the market's done. So from that perspective, I've been pretty happy with what I've generated so far. And I recognize that I have a position like Microsoft that was a huge tailwind, or something like Berkshire that's done pretty well. So I try not to get too hung up on the numbers at any given point in time, but obviously they're important to reflect on over long periods.
What would make you stop investing, if anything, and put your money in the market in like an index fund?
Just in an index fund?
Yeah. What would make you, well, basically it could be an index fund or a mutual fund, or like with a manager you like, but what would make you just say, hey, I don't have it anymore, or what?
I guess it'd have to be something like that. I mean, I guess in some ways I'd be biased in that assessment because I love playing the game so much.
Yeah.
So I don't know, but yeah, I'd have to be realistic about it. And, I think the way I tend to manage my investments, that the idea that I'm going to get a performance that's significantly worse or probably significantly better than the market over really long periods of time is probably, it's pretty unlikely in either direction, I'd say, just because of the type of investments I tend to hold and the quality of the businesses I tend to own. So, but yeah, if I had indicators that really suggested I was not doing a very good job, I'd have to think about that pretty hard.
That makes sense. So we can wrap up the interview there. If there's how would you like people to follow you or find you? I know you're on Twitter and GuruFocus. You want to plug either of those, your Twitter tag or anything like that?
Yeah, sure. My Twitter tag is TSOH_investing. And then on GuruFocus, I write under the science of hitting. And as always, anybody who wants to reach out to me on Twitter is probably the best way. I'm always happy to talk about individual names, general ideas. As my one buddy, Bill Brewster, jokes around, I've probably written an article about any topic you'd want to discuss because I've been doing it for pretty long. So whether or not the articles of high quality is another question, but I've wrote about pretty much everything at this point. So I'd love talking about this stuff. So anybody feel free to reach out and let's talk.
Well, thank you so much for coming on the show. And I'll certainly put links to both your articles on GuruFocus and your Twitter account in the show notes. But anything else you'd like to say? I'll give you the last word on the podcast.
No, that's it. Thanks for having me. I appreciate it.
Thank you.
Thank you for listening to the DIY Investing Podcast. Please visit our website and subscribe to our email list at DIYinvesting.org for guides, videos, and resources to help make you a better investor.
The DIY Investing Podcast is presented for general informational and entertainment purposes only. I have not considered your specific situation or risk profile, and I have not provided investment advice. The information presented on the DIY Investing Podcast should not be construed as investment advice. The views and opinions expressed on the DIY Investing Podcast are those of the participants and do not necessarily reflect those of the show's host or sponsors. DIY Investing, its producers, sponsors, and host, Trey Henniger, shall not be liable for losses resulting from investment decisions based upon information or viewpoints presented on the DIY Investing Podcast.